Good morning and welcome back to the show. It is 6:34, Real Investment Show. I'm your host, Lance Roberts. Danny Ratliff. Futures pointing slightly lower this morning as, well, everybody's kind of awaiting to see what's going to happen with the trade deal today. So the trade deal, and I tweeted out this morning, I was like, right now we have QE, not QE.
Oh, yeah.
Right? Because the Fed is not technically doing quantitative easing because they're buying T-bills. Which are short term and they roll over, but if the market thinks it's QE, and like I said, if it looks like a duck and I use
Walks
that
like a duck.
yeah, and I use that around that. I'll be on the phone. So my wife has this massive affinity for baby ducks.
Okay.
No, and I am dead serious about this. And so, like, if baby ducks come on television, or like one day we were driving, we're going to eat, and we're in the car, and this mother duck is crossing the street with these little baby ducks behind it. She slams on the brakes and stops the car and watches these baby ducks cross the street. She's like, baby ducks! She gets so excited over baby ducks. This is like her thing. And so the other day I'm on the phone upstairs in my office and I'm talking and I say the line, right, to the guy I'm talking to, because he's asking me about quantitative, not QE. And I said, basically the markets look at it as if it looks like a duck and walks like a duck. And from downstairs I hear, baby ducks!
Oh, man. See, she'd love our neighborhood. We don't have, like, watch out for kids signs. We have duck signs. I'm like, come on, man. You got people flying down the street and we're worried about ducks, not the kids.
Just like, well, ducks are important. But anyway, but if you kind of look at this trade deal, and as I was saying earlier, we're going to, everybody's kind of waiting today for the signing of the trade deal. But it's almost like a trade deal, not trade deal. Because we're not really changing anything. We're kind of just resetting the table to where we were, but not even completely because we haven't removed all the tariffs. So we're not even getting back to where we were in 2017. So it's kind of a trade deal, not trade deal, kind of like QE, not QE. But the markets, are excited about getting something done to get rid of it.
Well, I think they're excited because this is just technically phase one. It looks like it's a step in the right direction. And then we know that phase two will not come until after the election.
Right, if ever.
So that's right. So if ever. So if Trump's not reelected, we won't see a phase two. It'll probably all go away and they move on down the road.
Exactly.
So the market, I guess, views this as, hey, we have, 8 months or 10 months of freedom here.
Exactly.
So who knows?
Yeah, exactly. But again, the important thing is for the markets and for investing and for the economy, right, does the trade deal alleviate the pressure so that we can sell more product and, get more things accomplished and grow the economy? Those are the type of things because, regardless of how you want to look at it, tariffs are a tax. And they are a tax ultimately on consumers. And you take a look at washers and dryers, you take a look at things that consumers are buying, and those exports and sales of those products have actually declined because, well, they cost more, right? And so if we can remove those tariffs, prices will come down and we'll be able to sell more stuff. So that's really kind of the key thing about getting, removing tariffs. And unfortunately, this phase one trade deal doesn't really remove a lot of the tariffs. It just keeps more tariffs from being added. And which is an important thing, and it's a good thing because the tariffs that were slated to be added were the ones that would directly impact consumers the most because it was on electronics and iPads and iPhones and those type of things. But Tim Cook, in his sanity, got a hold of Donald Trump by the collar and said, don't do that. That will be very bad for the economy if you tax our products coming out of China.
Well, and
so that dropped really quick.
And every parent in America will have to actually watch their children instead of giving them the iPad. So, yeah.
Exactly.
But so this is kind of indicative of that late stage cycle, trying to find other things that can really push things forward. And so I think, looking at what Larry Fink at BlackRock's looking to do is trying to find something else, another niche. We're seeing that in a lot of different areas. And so one question I think we're certainly getting as people are getting more exuberant, they're feeling good about themselves, the market, their job, is that, okay, hey, I don't have to have. And so one question I've got quite a bit here recently is that I have too much in cash.
Right.
And, one thing that we always discuss is cash is not a bad position to be in because it provides you flexibility, security. It gives you a number of things that the market just can't quite technically do. And right now, if we think about the market is red hot. So when you put funds in, you're likely to get burned at some point.
Sure.
And so being able to define a strategy within your financial plan on how you should have cash, where you should put it, and then how to actually utilize these things, I think is very important. And so Rich and I have talked a lot about, maybe forming what we call, quote unquote, a financial vulnerability cushion. So the average advisor is going to say, hey, keep 3 to 6 months of expenses in an account for an emergency, right?
Sure.
You lose your job, something happens, AC goes out. And one thing we've looked at a lot of different studies, and that shows that could be a little bit light in some cases,
Right.
Especially at this stage in the cycle where, look, if something bad happens in the markets, it's not going to be just the markets. It's going to be the economy, which is going to impact people's jobs. So what happens if in that financial vulnerability cushion where you need to actually, you have to physically start paying bills because you don't have the income coming in? What happens if somebody gets sick in your family? So, what happens if your spouse loses a job, or you need to take time off to take care of a child? Or, we can go on and on with the list.
Right. But y'all are calling it a financial stability cushion.
Vulnerability
Cushion. This segment brought to you by Sleep Number 360.
Oh man.
But that it's a great idea because again, there are alternatives to just if you have cash, putting it into the markets. And for instance, whole life insurance, it gets a bad rap from other advisors and things like this because they don't really understand how to use it properly. But whole life insurance is a great way that you can invest cash safely, create an annualized compounded rate of return out of it that grows tax-free with tax-free withdrawals. And I use it personally within to supplement our trust account for our family. And I overfund it every month, and I pay in excess of the premium, and the excess that I pay into the premium falls into a cash account that compounds every year because it grows at 5 or 6% every single year, regardless of what the market does, and it grows tax-free.
Well, permanent life insurance, that's the whole, we could have a whole segment, a whole show on just that and the uses. And now with the Secure Act, so kind of switching gears a little bit, this is another way people can put funds to work. And so technically what you're referring to, you're not putting those funds in there necessarily for the life insurance, quote unquote. You're putting the funds in there for the potential growth, the stability and protection it can provide in bad markets. But it's going to be even more important. So now, I had a conversation with somebody yesterday, in fact, and they said, look, I need to make my IRA contribution. I said, look, you don't need to make an IRA contribution. You make too much money. And so you're going to make this contribution. It's not going to be deductible. You're going to get no benefit from it. You make too much for a Roth. You can put funds in a traditional, but it doesn't mean you should just because you can, because it's not going to provide you any real tax benefit. That's going to be a pain. You need to report it every year that you have a non-deductible contribution. He says, well, where in the heck do I put money? I've got a ton of money in cash. And this could be really an ideal placement within a financial plan that would say, hey, here's an idea of where you can put funds. It's a little more sophisticated in nature. It is going to be something that, a lot of very affluent people do. And it's a way if you do it properly. And I can't stress doing it properly because I see these plans that are that people do. And essentially what happens over time is that they don't actually, it's not done correctly.
Right.
And what I mean by that is that the idea behind this is that you want to put these funds aside. You want to overfund it. Yes, you want your life insurance. Term is fantastic for your general life insurance. But for what you're looking to do, like Lance was mentioning, to overfund something, and you want to have these funds actually grow over time, you need to be able to do this right. And you need to be able to do it where, the account does something funny. They give you credit. They credit you. So you want to take a loan, not a withdrawal from these types of products. Right. But you want to kind of use arbitrage, essentially, because you want to be able to earn more in interest or have the ability to earn more than what the interest they charge you.
Yeah, let me give you a good example because I just did this. Okay. So I've been overfunding my life insurance policy for years.
Yep.
So I have a pretty hefty cash balance that's been growing tax-free. And so that balance is credited every year at 6%. I took out a loan recently, and against my policy, I took out a loan because I do hard money lending for real estate as a kind of a side hobby. So I took out a loan against my policy. So it's an effective use of leverage. So my loan interest rate is 4%, and I'm credited 6%. Now, the money I took out, I have now loaned out at 10% interest for 2 years against a collateralized piece of property. So I'm fully secured. And so the position's fully collateralized. I've got no risk. And this is the important thing. You can't have risk. You can't invest it in the stock market.
Yeah.
Because if you lose the money, now you've completely destroyed the whole reason for doing it. But now I've got a spread of 10% versus 4%, so I'm picking up an additional 6% spread. But here's the really cool deal. The money that I borrowed against my policy is not really counted against the accrual rate of the policy. The entire balance is still accruing at 6% every year, even though I have a credit against it. So when you do it properly, it's a fantastic way to use some leverage effectively to increase your overall rate of return and the growth of your portfolio. So,
yeah, and I think that's the main thing. Is so the trouble I see with these things is that, one, when you get to that time to make distributions, you find out all of a sudden that, oh, well, you're actually being charged 6% of credit and you're only going to earn 4%. And so what happens is it actually accumulates, more of what you have to pay over time, and then it's going to depreciate the value of your overall policy. Yeah. And that is the trouble with that. So you need to be very mindful on how this is done. There's only a select few products that actually, at this day and age, will allow you to do that effectively.
Yep.
And so that's why you need to be very selective. We look at policies all the time where they say, yeah, I've got this. It looks great. And then you look under the hood and you're like, whoa, hey.
Yeah. No, it is true. I mean, you've got to be very careful about how you do it. But it's got to be it's got to be built into the plan. It's got to be structured. But it's something you have to commit to. You can't just kind of do it for a year, then not do it anymore. So it's a plan that you have to commit to long term. But it is such a great way to build a tax-free shelter for your retirement that people just overlook because basically, there's people in the financial media that poo-poo these because they'd rather sell you term insurance. But the problem with term insurance is it expires worthless.
Well,
and you have nothing after you pay into
they want you to do the term insurance, then you go invest the rest. But the issue is
that never
you
happens.
Invest the rest. It doesn't happen. And so we talk a lot about taxes with Medicare, Social Security, all these other things, and potentially taxes going up. This is an effective way to be able to take distributions, not impact that.
There you go. All right, be right back. Don't go away.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.